And I kind of view us as being in a lost decade where I just don't think the 2020s decade from the recent, peak in 2021, I don't think it's going to be looked back on as a very good decade, especially in inflation adjusted terms and probably not that great in nominal terms either.
Bitcoin, BTC, and US stocks have entered one of their strongest seasonal period of the year. The top cryptocurrency by market value has chalked up gains in April in 6 out of the past 10 years, averaging a return of more than 17%, according to data tracked by crypto services provider Matrixport. Over the past 10 years, April has been the best month in the year's first half, and the third best month for the full year for Bitcoin. Hello and welcome to Money Talks. In today's video, Lyn Alden updates us about the current banking crisis and her outlook for the U.S. economy in 2023.
I think basically flat to down in nominal terms and down in real terms is probably how I look at corporate earnings overall. Generally in inflationary periods, it's kind of hard to get a really deeply not like nominal decline just because the unit of account is changing so much. But you certainly can get somewhat down nominally, which can be quite down in real terms. And so generally especially the large cap, just, basically like the big index is just, I think not a very attractive. And I kind of view us as being in a lost decade where I just don't think the 2020s decade from the recent, peak in 2021, I don't think it's going to be looked back on as a very good decade, especially in inflation adjusted terms and probably not that great in nominal terms either. And I think this year is kind of a microcosm of that, where I'm not necessarily expecting massive crashes unless officials try to cause like a absolutely severe liquidity crisis. But I'm also not expecting very bullishness action either. I think it'll be very sector specific. And I think a lot of things are just going to be grindy and sideways and choppy and volatile. And sideways can mean down 20%, up 20% in a given area.
Yeah.
And just, when you look back a year from now, 5 years from now, you're kind of like, we didn't really go anywhere. Yeah, we had 40 years of declining interest rates, which means, one, you got higher corporate profit margins, but then you also had higher valuations placed on those earnings. And so you had multiple tailwinds causing everything to go up together for like 40 years. And just going forward, I think some of those tailwinds are gone now. We don't really have the benefits of globalization we have over the past 30 years. We don't have the tailwind of ever lower interest rates. And so I think a lot of that is behind us. And now things are in a grindier environment, at least this decade. And that requires more careful sector analysis, more careful company analysis. It's also like when things are the top of the range, you can like sell covered calls to get extra income and extract kind of more value out of that position. When things have a big down move, you can maybe move, some of your T-bill position back into the market. There's different things you can do to kind of adjust the ebbs and the flows. And there are sectors that, for example, on the opposite side of this bank problem, for example, like certain energy pipelines, right? What they, like energy product, for example, like EPD, what they did was Enterprise Product Partners, that's the rate. So what they did was basically they borrowed an average rate of 20 years at a pretty low interest rate. And then they have all this, real asset exposure. And so they have, 25 years of distribution increases. They yield over 7%. They have all this low fixed rate debt. And so they're kind of sitting on the opposite side of what all these banks are dealing with, where they lent at long durations at low rates. So one thing to look for is what areas borrowed for long duration at low rates that are fixed and that have variable or real asset underpinnings. And so those are the ones that I think can grind out an advantage over this decade, where they're not reliant on interest rates coming down. They're not reliant on ever higher valuations. They're just operating profitable businesses with their debt denominated in like negative real rates, right, and returning capital to shareholders. Yeah. And so I think that there's, between covered calls, whatever tools that an investor's familiar with kind of grinding through a sideways decade I think is the type of action to be familiar with here.
Will April bring showers or more sunshine for Bitcoin? The weekend offered few clues as the largest cryptocurrency by market capitalization kicked off the new month holding at late March levels as investors weighed recent events, bank failures, inflation, and crypto-focused regulatory actions that could push prices higher or drag them down.
Yeah, I think T-bills, money markets, those are some of the best low volatility defensive assets. I think gold is attractive here. Um, you know, it, it's possible that gold stagnates for a little bit because there was a recent buying pressure into gold that might settle out and normalize for a period of time. But I think that as the Fed kind of finishes their hawkish cycle, I think it's attractive for gold. Like I said, some of those income producing assets that have kind of low fixed rate debt are attractive. And That's kind of the general approach here. I think I've been watching energy producers lately, energy and energy producers, because a lot of that was sold off sharply with the banking crisis. I think some of that's overdone to the downside.
Mm-hmm.
Now, I'm still hesitant to be super bullish on energy with a somewhat recessionary outlook. So I kind of caveat that with, I'm not saying we can't see lower, but I am both long-term bullish on some of those. And even in the intermediate sense, I think it's somewhat overdone to the downside. So I think it's worth shopping around or looking around in that space in the weeks and months ahead for anything that crashes in that space could be a interesting purchase. I think, for example, the 2-year peak, there's a good chance that's in. There's certain tail risks that can happen with the longer duration assets. I mean, if the market, especially the next inflation cycle, if the market perceives that the Fed's kind of given up on their inflation fight and, they expect longer inflation, like basically higher inflation for longer, some of those long duration yields could actually have an upward move. I don't really expect that right away, but it's something I'd be concerned about. I still think that long duration bonds are basically going to give you a lot of volatility without a lot of returns this decade.
Mm-hmm.
And so, a trader could make use of them, but I'd be pretty careful with them. Again, I don't know if the Fed's going to try to push through another 25 basis point hike or not. I try not to be, too sure around what they're going to do on the margins because it kind of comes down to one person's decision, and I haven't met the guy. So,
Right.
I can only kind of look at what market's pricing. I can look at what some of the ramifications are if they try to keep raising. I also see disinflationary pressures in the intermediate term, which gives them, reason to remain tight to varying degrees, but not necessarily reasons to keep tightening. And so I think Powell's incentives are aligned with kind of a pause and see here.
This week, investors will have a fresh set of employment and productivity data to gauge whether the U.S. economy is continuing to contract as recent signs have suggested or powering forward. The U.S. Census Bureau will release February durable goods orders on Tuesday, with expectations for a 1% month-over-month decline. And on Friday, the U.S. Labor Department will announce March's non-farm payrolls, with expectations for a 225,000 job spike and the monthly unemployment rate, which is expected to remain at its current 3.6%. A hot jobs market has figured prominently in central bankers' contemplations about the ongoing strength of the economy, which historically leads to higher inflation readings. In an interview with CoinDesk TV, Mark Chandler, Bannockburn Global Forex Managing Director and Chief Market Strategist, said that the financial stress that we saw earlier this month is receding. This is allowing the market to focus on two things, which was before the banking stress, he said, adding a note of caution. One is that the labor market remains fairly robust, and inflation is too high for the Federal Reserve. So, has Bitcoin benefited from the banking crisis? Tell us in the comments. Also, don't forget to like and subscribe. See you soon with the next video. Thank you so much for watching.